Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go on to Twitter, see what people are sharing on Twitter, and I'll be making a bunch of comments on their comments. It's going to be related to three topics mainly: wealth building, financial topics, and commodities. I think commodities are the cheapest sector uh, basically in the world. It is out of favor still, even though it came into favor 2020, 2021. I think that was wave one. We had a wave two pullback, and hopefully we're ending wave two pullback at some point, which will be easily seen looking backwards, not being in it, and then enter wave three. Some sectors may have already entered wave three. Other sectors are still working their way coming on up out of wave two. So let's take a look, see what's going on in the markets. Today, we've got at finding_finance, and we got finding-value.com. If you want to join our community, that's where I talk about individual companies, how I'm positioning for this commodity bull market. And we still have a coupon code special going on called Holidays. So, coming on down, we've got Elon Musk. I'm going to say it backwards, IED, because it discriminates on the basis of those things. It is not merely immoral, it is also illegal. And I agree. We were implementing those things at my last company, and that is one of the reasons why I did not like working for them. So go Elon, fight the fight for what I would consider to be equality. NQF, one day, it says traps. And I'm just focusing on the pattern here, guys. A lot of the times you get a big move lower, it comes down, then you get a nice little like bottom here, comes back up, and then it hits it again, and then you rip all the way up. Are we putting in a bull trap? And here is the bear trap. I think we kind of are. One weird thing is, was this last move here a function of the Fed buying the markets to push prices of a lot of these people's stock options high as it ends in 2023, so they get payouts? A lot of the buddies, at least that's what a lot of people were talking about. And then this new year, they're not doing that anymore, so things are falling back down. I don't know. Kind of interesting. 2022 was one of the worst years ever for both stocks and bonds. 2023 fortunately turned things around in a big way. 2022 is the same market condition as 1969, which is the same market condition as 1931. And that's all in these locations over here. Those were all the beginning of commodity bull markets. So 2023, yep, it probably had interest rates go up, push the markets down in 2022 and also the bond market. And then 2023's, my guess, is probably going to be a double top. And then it's going to work its way sideways to lower again as commodities take off and interest rates chase it higher for another wave of inflation eventually. I don't know if we are at the complete bottom. Maybe we bottom later in 2024, where we launch later 2024. Tough to say. But I think that this could be a double top, much like this is a bull trap, and this could be coming back down. So then what you have is, depending on where you have your start and stop points within the year, you could clock a good year here, a bad year here, and then a good year here again. And that's really a double top over a multi-year time frame. Remember, all these are just they're magically made up start and end points. Well, I guess our calendars are. And the start and stop points, you should look at it as one continuous movement instead of these herky-jerky start and stop points throughout the cycles. Coming down, Russell minus 5% in 3 sessions, the 8-day gone, the 21-day gone. What comes next, folks? And that's the selling pressure after kind of hitting this new year. and getting strong selling pressure there. I don't know if it's just going to be a top in the Russell. I know the Russell's down quite a bit, but I don't think we're going to just rocket higher. I know there's some people who think that we are going to move way up in the S&P 500 and that we're not going to get a recession. Things are not going to slow down. Some people have that in their head. Others think that the recession is baked in the cake, that we are going to have a recession in 2024 with the same confidence that we were going to have a recession in 2023. I will say that there is the probability of a slowdown. Maybe the slowdown's behind us, and maybe the economy will gain some traction, but the stock market may not gain some traction. Generally, under strong economies with higher rates of inflation and strong demand, we see stocks go down because of the increase in interest rates. Is interest rates going to increase here? I don't know. And that's what we're looking for. A trend, a new trend to establish itself. Manufacturing construction spending in the U.S. continues to hit new record highs, more than doubling over the last 2 years. There we are, ripping to the upside over the last 2 years. So again, this is a function of strength in the economy. It creates jobs, employment. That's why construction employment's way up and construction spending is way up. So that is kind of what's holding a lot of this up, is construction spending. 390 area starting to look appetizing for QQQ. What that is you've got a rising wedge and a potential move to the 390 area where we've got some support. So nice looking chart here. He's got a little rising wedge there. Kind of cool for the Qs. Charlie, the ISM manufacturing PMI has been below 50 in contraction for 14 straight months, the longest down streak since 2001. So there's that move lower here. We just don't have a recession bar. And a lot of people say, oh, we're going to go into recession. Guys, it already happened. Like, I think it's already behind us. The slowdown occurred from 2021 onward. And I think we're going to get another upcycle at some point here with liquidity worldwide. And I know this is the United States ISM manufacturing, but we'll see what the United States does with rates and with liquidity and stimulus and all of that. Perhaps the crude oil to gold ratio about to explode higher here. And this is an uptrend here, downtrend here, and then we've broken that downtrend and falling wedge pattern to the upside. And now we're doing a retest, and eventually we'll work our way higher. I think that's underway. I really do think that could potentially be underway here, where we start to move on higher here. Oil remains the most hated commodity. Such a crowded trade. Is this trade really that easy? Lower oil prices ahead? Question mark. It says speculators are least bullish on oil on record. Annual average net long positions stand at the lowest on records dating to 2011. Combined oil net long positions is the black. The annual average net longs is the yellow. To me, this looks like we are bottoming and we're going to head higher. You can also look up, this is 2018 as the peak there. 2018 is the peak here. So you can see that the net long positioning is moving up and down based off of this chart here. This recent move is this recent move here at the end. So, and the big move in 2020 is this big one coming up. That's this guy here. So I think we are bottoming. I think it's super bearish sentiment in oil right now, and I love it. I'll be a buyer of this all day. I'll be a buyer all day. Let's keep being bearish, guys. Hold the price down for a little while. Give me an entry point, guys. Many commodities are among the cheapest and most shorted assets among the fast money crowd coming into 2024. Wow, rice is the most expensive overbought. Platinum. Then we've got oil down here. All the oils are over here. Gasoline, copper, cheap over and overbought. We've got ethanol, bean oil, crude oils right here in cheap and oversold. Nat gas is over there. We've got wheat, sugar, white sugar, oil share, Brent, crude oil, Chicago wheat, soybeans. That's all in the cheap areas. Expensive and oversold, cattle hogs, silver, feeder cattle, orange juice. So there you go. We had record-breaking year for stocks in 2023, but now what? Question mark. We've got industrials, new high, semiconductors, technology XLK, and home builders XHB breaking out. I think we're going to get a pullback, but I think we've got a chance of moving higher again. Depending on rates, though, it really depends on interest rates. If interest rates keep going up, I think it's a strong, stiff headwind for a lot of these sectors. If rates come back down, I think they'll continue to go higher for a period of time, unless the yield curve uninverts. Bullish weekly EIA data for the final week of 23, total commercial petroleum stocks are down 18 million barrels of oil equivalent week over week, resulting in a respectable draw for quarter four. So WTI's fair value of $77 or $5 undervalued currently. This week and next have high wonk factor, so reversal of big draw possible. So the blue line here, we're undervalued a little bit by $5 when looking at commercial oil pricing and how the front month price is generally priced. So we're slightly undervalued. More rate hikes to come if oil climbs again. Ed Yardeni. Yeah, I would agree. And we'll see if oil climbs. And I think rates are going to follow oil. That's generally the historical trend. Peter Lynch says, I don't believe in predicting markets. I believe in buying great companies, especially companies that are undervalued and or underappreciated. And there's a lot of companies that are in the commodity sector that are undervalued and or underappreciated with negative sentiment. So again, I agree with Peter. I don't think predicting the markets is a good thing. I think focus on what you can control. And that's buying great companies that are undervalued and then holding them for the long term. Silver bottom, this guy's bottom. And are we at a bottom today? I don't know. We'll see. We'll see. Everyone believes the economy is recession-proof, yet the ISM today shows that the grand total of 5.6% of purchasing managers are experiencing any growth. Last time we were here, try April of 2009. But here's the thing, April of 2009 was the best buying opportunity that the market, I think, had at any time that I've been an investor that I can remember for regular stocks. So when this comes all the way down like it has, we've already had the slowdown. When we're at this really negative sentiment level, that's the time to buy, which is kind of weird. Everyone's saying, oh, just wait for this recession. The slowdown has already occurred. That's why we're down at this level. That's why people are looking at this and they're like, oh, you think it's recession proof? We already went through it. That's like saying, we lost the game. You know, we could lose the game and the game was already lost. Like that game has already been played. It's done. So, looking at this, I mean, yeah, I can go down a little bit, but where's your risk reward here? Generally, you need to be fearful when you're up at the top and you want to be very greedy at the bottoms here. These were the best times to buy historically. So why is everyone saying, oh, there's going to be this huge, it already did. It's already slowed down. That's what this is showing us. What's going on with well performance in the Permian? With more and more data rolling in for 2023, we're able to paint a better picture of how the performance trends have continued since the significant drop in 2022. For this analysis, I'm comparing per well production for wells starting in 2019 and wells starting in 2023. By going back to 2019, we removed some of the COVID era noise when operators dramatically cut back their developments. We find a per foot production drop ranging from minus 12% for Eddy County down to minus 20% for Lee County, with Midland and Martin counties coming in at minus 15 and minus 13. These numbers represent the average 6-month cumulative oil production for wells in that cohort, normalized to a 10,000-foot lateral. Lee County in particular is worth focusing on as it produces by far the most of any county in the country, clocking in right around 1 million barrels a day. With that volume of production, any decline in per well performance is worth examining. Interestingly, lateral lengths have not changed significantly over the past few years in Lee, with operators drilling an average of 8,408 feet in 2021 and 8,515 in 2023. Proppant intensity has fallen around 10%, combined with some operators drilling fringier acreage and more parent-child relationships to deal with. Very interesting trends worth keeping an eye on. We'll be diving deeper into trends in the Delaware to start the year. Of course, 6 months of production is not illustrative of the full lifetime well performance, but so far it's held up pretty well as a metric. So look at this, guys. Well performance is falling in the Permian. Top countries show surprising per foot production drop since 2019. Here's your counties, and you can clearly see in 2019 that we've got some sort of drop going on in what people would consider to be the most important area left in the world for production. Are we actually going to see this drop? I should try to get this guy on. That's pretty awesome data. Tavi says, very interesting sentence from the FOMC minutes. Several participants noted the risk that if labor demand were to weaken substantially further, the labor market could transition quickly from a gradual easing to a more abrupt downshift in conditions. If the labor market deteriorates further, none of us will own enough hard assets. You got that right, because they're just going to print money to blow it to the upside. Why is the Fed so scared to let the economy fall into recession? It cleanses the system of bad debts and kills off inflation. It's probably exactly what we need. Life can't always be filled with unicorns and rainbows. Well, I got an answer for that. You can't lose your job if you are living paycheck to paycheck and you've got massive amounts of debt. The government can't lose tax revenue without the tax revenues. They can't allow tax revenues to drop with this amount of debt. A crisis occurs when you've got a whole bunch of debt in the system. Bad debts. So when he says it cleanses the system of bad debts and kills off inflation, that is true. But the problem is you could start a deleveraging process, much like the massive deflationary crash in the 1930s. The big, Great Depression. When you were so levered up, you can't let this system kind of default because the whole thing will implode. So what they have to do is they have to continually push it into an inflationary stance to not keep the system from imploding on itself. And that's why in 2020, when they stopped the economy, they overdid it with spending. They did not want it to roll back into a deflationary collapse. So they erred on the side of inflation. They're going to do the same thing if we enter an era where we get not enough growth and tax revenues drop. They're just going to pump the system again. They need to inflate their way out of it. You can't deflate your way. Deflation will kill everything. If you don't have enough money in the system, and with the debts in a lot of these states and our country, you need higher tax revenues. And the only way to get out of that is to nominally bring those revenues up. So this is a game of nominal right now. Not of real growth, but of nominal pricing. So you can get taxes up and all these things up so that the states can keep going and the system can keep running. Calvin says, if you're mad about VTNR and want a refund of subscription fees because you lost money on it, DM me and I will refund all of your subscription payments to date and cancel your subscription. And while that is honorable, what I'm going to say is No one in this world is going to be 100% right with their picks. Absolutely no one. There's going to be times in this market where things go down. There's going to be times in the market where things go up a lot. Timing that is really difficult. So I looked at VTNR. VTNR does not look that bad to me. Yes, they got absolutely smoked recently, but guess what? I'm going to tell you this, guys. I've been in the market for a long time. I've seen earnings releases where companies go down 20, 30%. And some of the releases weren't even that bad. They weren't even that bad, but the market just smoked them. It's going to happen to you. It's going to happen to absolutely everyone. If the company is a good company, hold on to it and wait. If it's something that is essentially bad and changes the fundamentals of the company, okay, I get it. But no one's going to get things perfect. I know I was reading the comments section once and people were like, oh, well, what about a couple of bad picks that I had? You need to be held accountable. Guys, that's part of the game. Having some losers means that you're taking enough risk to try to actually make money. If you have zero losers, that is unbelievably unrisky. And all you're doing is sitting in bonds. There's going to be a timing component. There's going to be a value component. And then there's going to be, the market conditions that changes those things. You can get real close to what is potentially an area of a bottom, and you may have to hold it for a couple of years for it to work out. I know some people were talking about CTRM, and that's way up the past few days. I'm not saying that CTRM is a good or bad company, but it is up now from where it was when I was talking about it. And remember, they also have Toro shares that were broken out from that. But I know some people are like, well, talk about your losses. You're going to have losses. Everyone's going to have losses at some point. What you need to do is, what's the strategy for it? I can sell a company with a 20, 30% loss and it has no impact on me. Why is that? Because it's part of the game. And the reason that we go into a lot of these companies is because the symmetry, tons of upside, limited downside risk. The downside could still be 30, 40, 50%, even though there's limited downside risk. But your upside potential in the majority of these companies is over 10 times. So you have to ride the big winners up over 10x, and then you cut your losses or realize those losses in tax loss harvesting as a strategy to reduce your taxable income. You can claim up to about $3,000 a year, or you can offset those losses with gains that you've had in the year. So it's part of the strategy, and it's going to happen to absolutely everyone. It happened to Calvin here, and I have no hard feelings for Calvin, but it's part of the game. I mean, this is going to occur, and it's going to happen to absolutely everyone who takes on any sort of risk. You are going to have losses, and your portfolio position size should be sized in a way that it doesn't crush your portfolio. When I invest, I don't put 50% of my portfolio in one stock. I don't even put, I don't put 30%. I don't put 20% in one stock. Now, I have a couple of stocks that are pretty big based off of where I bought them originally. But I still have good conviction in them. They're still of good value. They're still of good risk reward. And I don't see any reason to sell them. So I'm going to hold on. I just wanted to touch on that. There's no such thing as being accountable. If you think something looks good, you enter the stock. And let's say it doesn't work out as planned. I don't see what that means to be accountable. You don't have direct control necessarily over the outcome. We're playing with statistics and probabilities. We're looking for things where you can do a bunch of homework. The company can be completely undervalued. You come into a ripe market condition. And let's say you bought it. You're down 30% in it. What are you going to do? Well, is the entire sector going up? Is it still inflecting positive? If the answer is yes, you wait longer. You might have to wait a few years for it to inflect up. Even though you have a really good entry point, it may take longer than expected. So I think time frame is a big deal. It's a very, very big deal. As long as you're buying things that are down and you're not chasing things that are way up, you'll do very well. If you chase the price performance and think that the price performance will continue, then you could get into some trouble doing that type of method. This is how the economy works. You can see QE, inflation is high, rates rise, soft landing, recession, lower rates, economy is weak, do QE, and it just goes in a circle. That is what has been recently. Historically, though, and this isn't necessarily the economy, because some people confuse stocks with the economy. They're two different things. Generally, what can occur is a demographic comes into home buying years. That is when the economy strengthens. Inflation goes up. They raise rates. And then you get a potential slowdown in the housing market, or the demographic leaves, and then you crash. Most of these crashes are caused by the real estate cycle. And then they lower rates after we go into a hyper supply phase and into a recession, a deleveraging event in the market. And then we go back and circle back again where the demographic comes back into strong buying power. We build more homes, inflation goes up, and then they raise rates, etc. But there's now this thing here that this person has created where they think QE is driving everything. And maybe that is the case. But I will say inflation doesn't go high with QE necessarily. They did a bunch of quantitative easing in 2009, and it didn't really do much. They did QE in 2020 in the middle of an expansionary phase of real estate, and guess what happened? Massive inflation. They also sent checks directly to people. And that has obviously an impact. And that's where I'm going to end it, guys. So that's what I've got for today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you like. We have a 7 a.m. Saturday question and answer session coming up if you're interested. And hopefully everyone's hanging in there. We'll catch you later. This is Finding Value.